There are some unexploded bombs. One unexploded bomb is really the bomb that brought down, as an example, First Republic and Silicon Valley Bank, which is to say that they gorged on long-dated fixed-rate obligations, which they funded in short-term deposits. When the interest rate went up, the net present value of those obligations went down at the same time that the yield relative to their cost of capital collapsed. So you have institutions as large as the Bank of America that have really pretty ugly, unfunded holes.
You're watching Silver News Daily. Subscribe for more.
Did you know that silver could soon break its all-time high? Experts are calling it the investment opportunity of the decade. What's driving this unprecedented surge? Today, we're diving into Rick Rule's masterclass on why silver's moment is here. Trust me, you won't want to miss this. Let's break it down.
Very well capitalized, as opposed to 2008. The Fed, I think, had a sober moment post-2008. And the capital requirements for the banks are really pretty high. The FDIC, too, who I've been in front of for 2 years and 6 months, has been pretty rigorous in going over at least the nominal balance sheets of banks nationwide. The reason why our bank has been 2 years and 6 months in permitting has mostly to do with the fact that the FDIC is charged with policing troubled banks. And sadly, there's a lot of them. Every time a bank gets into trouble, our application gets deeper in the pile as opposed to moves up. And I need to say, 2.5 years of dealing with low-level people in the FDIC leaves me with a grudging admiration for those people. In answer to the question, there are some unexploded bombs. One unexploded bomb is really the bomb that brought down, as an example, First Republic and Silicon Valley Bank, which is to say that they gorged on long-dated fixed-rate obligations, which they funded in short-term deposits. When the interest rate went up, the net present value of those obligations went down at the same time that the yield relative to their cost of capital collapsed. So you have institutions as large as the Bank of America that have really pretty ugly, unfunded holes in their portfolio. Interestingly, the federal government, in their wisdom, allows banks, large and small, who have loans or bonds on their book to mark them as either held for sale or held to maturity. If those obligations are held to maturity, the banks are allowed to carry them on their books at par rather than at fair market value.
Silver has always been a fascinating asset, known for its dual identity as both a precious metal and an industrial powerhouse. But what makes today's silver market so unique? Let's look back. Historically, silver has seen incredible price spikes during times of economic uncertainty, hitting record highs like $50 per ounce in 1980 during the Hunt brothers' attempt to corner the market, and again in 2011 amidst the fallout from the global financial crisis. Now fast forward to today. Silver prices are hovering far below these peaks, even as demand surges in sectors like solar energy and advanced technology. Why hasn't silver caught up to its true potential? The answer lies in market cycles. Historically, silver's biggest rallies have often been preceded by a long period of underperformance, just like the one we're in now. But here's the kicker. The economic conditions driving those past spikes, supply shortages, inflationary pressures, and surging industrial demand, are all aligning once again. What does that mean for silver's future? Is it simply a matter of time before we see another explosive rally? Stay tuned because the factors in play today are even more compelling than they were in those historic bull runs.
If the market has legs, and I think this one does, that move will come down to the penny dreadfuls. And when you see the nothing, no account penny dreadfuls, the ones with $10 million market caps but no net present value, double and triple, it's time to begin to look for an asset class that's more out of favor. You need to remember that we reach certain periods of time where even in a good sector, even if you are a practiced investor or speculator, there's not much value left in the sector. That's what Warren Buffett is saying about the New York Stock Exchange. So it's important that people understand that. I believe that there is substantial value left in the gold equity sector. I believe, though, that for investors who aren't willing to do the work, naked commercial, for people who aren't willing to sit through the rule classroom, as an example, that people confine their investment in gold miners to the very, very, very highest quality companies. What you learn is in a real gold bull market, simple market beta, which I would define as the outperformance of the sector relative to the broad market, is so substantial that you'll get doubles or triples taking almost no operating and company risk. Now, if you're comparing that with a 10-bagger, which you might get with taking a lot of risk, that appears unattractive. But if you look at it in isolation, the idea of a low-risk double or triple over 5 years with handsome dividends while you wait, and by the way, with the probability of that outcome, as opposed to the possibility of a tenfold move in a lower quality company, for most people who aren't willing to do the work and can't afford psychologically or financially to take risk, they should, at least in this point in time in the market, confine their investments to the very, very, very highest quality gold equities.
Silver's industrial demand is reaching unprecedented levels, and it's no exaggeration to say it's one of the metal's biggest catalysts today. Around half of all silver demand comes from industrial uses, and it's not just about jewelry or traditional applications anymore. The green revolution is driving silver into the spotlight like never before. Let's start with solar panels. Did you know that silver is a key component in photovoltaic cells, which convert sunlight into energy? In 2023 alone, global solar capacity additions skyrocketed by 87%, and with governments doubling down on renewable energy, demand for silver in this sector is only set to grow. In fact, by 2027, solar manufacturing alone could require over 20% of the world's annual silver supply. Think about that, one industry consuming a fifth of the entire market. But that's not all. Silver's unmatched electrical conductivity and reflectivity make it indispensable in electronics, electric vehicles, and even military applications. As nations ramp up investments in advanced technology, silver is quietly becoming the backbone of innovations like 5G battery technology and green energy grids. So here's the big question. If demand is surging across all these industries, why isn't the price exploding yet? We'll get into that next, but for now, consider this. What happens when a finite resource meets insatiable industrial demand? Spoiler alert, it's a recipe for a potential silver boom.
And I suspect that for most investors, that is the way that they should organize their lives. The purchase of physical gold is really the purchase of insurance. And it's important that people buy insurance before they even invest. It's important that to the extent that it's possible, that you have an asset that will help your family sustain its lifestyle in bad circumstances, and that's physical gold. In a normal bull market, after the gold price has moved, to the extent that it's moved enough that producing companies generate increased profits. Because remember, when the gold price moves, often the price of inputs around mining it increase too. So that the margin increase that you would expect to see often doesn't occur for 3 or 4 quarters. And that's precisely what we've seen. But this year has seen a real lift in the prices of ultra high quality gold stocks. Agnico Eagle almost up 50%, Wheaton Precious up 45%. Even Franco-Nevada, the highest quality of all gold companies, despite the fact that they lost 15% of their asset base with the nationalization of Cobre Panama, is up substantially. If past is prologue, the momentum that we've seen established both in the metal and in the senior gold shares will begin to embolden investors, and they'll look at valuation discrepancies between the biggest and the best and the second tier, and they will move down market. If they don't move down market, the great big companies will enjoy higher share prices and lower cost of capital, and they'll take over the second tier companies. And after the second tier companies, the market will go to a riskier asset class, which is to say the single asset producers. And again, some investors will look at valuation discrepancies. Others will look at potential M&A, and that sector will benefit, and so on, and so on, and so on. Finally, assuming...
While industrial demand for silver is surging, there's another critical factor at play: supply constraints. Let's dive into the numbers. Silver has been in a supply deficit for the past 3 years, with demand consistently outstripping new production. In 2023 alone, the deficit was a staggering 184.3 million ounces, and projections for 2024 suggest an even larger shortfall of 215 million ounces. To put it simply, the world is using far more silver than it can produce. Here's why that's a problem. Mining operations, the backbone of silver supply, are struggling to keep up. Many of the largest silver deposits have been operating for decades, and new discoveries are becoming increasingly rare. High-quality ores are depleting, and the cost of extracting silver from lower-grade deposits is rising. Combine that with political instability in key mining regions like Peru and Mexico, and you have a recipe for shrinking supply. Even recycling, which accounts for around 15–20% of silver supply, isn't enough to bridge the gap. While higher prices might incentivize more recycling, the process is costly and can't fully replace mined silver. So what happens when industrial demand skyrockets but supply keeps shrinking? It creates a classic economic imbalance, with the potential to push prices dramatically higher. But as we'll see, the market dynamics of silver are far more complex, and other forces are influencing this delicate balance. Ready to find out more? Stay with me.
I've been systematically buying physical gold since 1999. I don't need to buy more gold. I'm going to buy more gold, but the fact is I own lots relative to what I might need. Other people are less fortunate. Most of the American public, if pressed, probably couldn't spell gold. And I think they need to begin the process of systematic acquisition of gold, unless they have some other internal inflation hedge that works for them. In fact, with regards to my own circumstance, a good financial planner would look at my estate, being the largest shareholder of Sprott, and say, why do you own gold at all? If the gold price does well, the businesses that you own will prosper, and you'll win by proxy. I own gold because it's insurance. It helps me sleep nights and stay calm. Sleep is a good attribute if you're 71 years of age. So everybody's circumstance is different. For people who have their lives structured in a way that persistent inflation will be ugly for them, people with long bond portfolios, people relying on conventional pensions, particularly defined benefit pensions, I think they need to begin the process of the systematic acquisition of assets that are traditional inflation hedges, and they need to do it now. If the price of those assets falls, God bless. If I'm wrong, then your conventional pension will do a good job for you. But I would ask those people to consider the probabilities of what I've said and judge their actions accordingly. I have found myself, if you look at the whole of my net worth, the whole of my portfolio, I found myself adding cash. It is not a deliberate strategy. I'm not trying to get liquid. I am already too liquid. What's happening is that some of my speculative bets and some of my investments have paid off. They've gotten to the point where they're no longer cheap, so I sell them, and I haven't been able to redeploy the money. It was interesting. I'm not trying to liken myself to Warren Buffett, but I listened to Buffett's discussion the other day about the cash holdings of Berkshire Hathaway exceeding $300 billion. And what he said is, I'm finding myself opportunity constrained. He isn't suggesting that the market's going to collapse. He is suggesting that when he looks to buy businesses in the size and of the quality that attracts him, that there aren't very many opportunities. At the same time, some of the existing businesses that he owns in a large measure, Apple as an example, Bank of America as an example, are at this price, relative to the earnings stream he sees them generating over the next 5 to 10 years, less attractive. He hasn't been a seller from a strategic point of view. He's been a seller from a tactical point of view.
Now, let's turn to one of the most fascinating dynamics in the silver market, the role of investment demand. While industrial use is the bedrock of silver consumption, the metal's status as a financial asset plays a crucial role in its price movements. Silver has historically been a favorite of contrarian investors, particularly during times of economic uncertainty. Why? Because silver, like gold, is seen as a safe haven, a hedge against inflation, currency devaluation, and economic instability. However, in recent years, silver investment demand has faced some headwinds. In 2023, for instance, demand for silver bars and coins dropped by 16% from the previous year's record highs. So, what's behind this dip? A combination of factors, including volatile prices and increased competition from other investment assets like equities and cryptocurrencies, have temporarily sidelined some investors. But here's the interesting part. The tides might be turning. With growing awareness of silver's undervaluation compared to gold, remember, the gold-to-silver ratio is historically high. Many investors are beginning to see silver as a bargain. And when you factor in the potential for a supply crunch, the case for silver as a long-term investment becomes even stronger. The question now is, will we see a renewed surge of interest in silver as both a financial asset and an industrial necessity? History tells us that when silver gets its moment in the spotlight, the moves can be explosive. But the next piece of the puzzle could be the gold-to-silver ratio itself. Let's explore this key metric next.
Customer backlog. When we opened the bank, there was nobody who had expressed any interest in doing business with us, except for close friends and business associates. Almost 16,000 people now have said that they want to do business with Battle Bank as borrowers against precious metals, as depositors in high-yield money market accounts, or depositors in foreign currency insured accounts. It has been gratifying to see almost 16,000 people nationwide, in fact worldwide, express an interest in doing business with Battle Bank. We believe now, with the acquisition of a bank charter and with the regulatory process simplified in terms of simply a new business plan, which, by the way, will be funded with equity in escrow. We really look forward to getting started. For those of your listeners who aren't familiar with our prior effort, beginning in 1998, if my memory serves me correctly, we formed one of the nation's first online banks called EverBank. I'm delighted to say that the original strategy session occurred on my living room floor. And we were able, over 14 years, to attract 275,000 plus or minus depositors. And we grew the institution to $28 billion in deposits. At that point in time, we sold the bank to TIAA-CREF, who have, by the way, done a great job for their members. The difficulty came in the fact that their members, and there's 1.5 million of them, have different banking needs than the clients that we had served at Everbank. The annuity needs of retired teachers are different than the banking needs of, if you will, the aspiring class of entrepreneurs nationwide. And so what happened was, beginning at the time we sold the bank, which if my memory serves me well was 2014, the 275,000 people that we attracted to Everbank found that their bank deserted them.
Now, let's turn to one of the most fascinating dynamics in the silver market, the role of investment demand. While industrial use is the bedrock of silver consumption, the metal's status as a financial asset plays a crucial role in its price movements. Silver has historically been a favorite of contra-Rhine investors, particularly during times of economic uncertainty. Why? Because silver, like gold, is seen as a safe haven, a hedge against inflation, currency devaluation, and economic instability. However, in recent years, silver investment demand has faced some headwinds. In 2023, for instance, demand for silver bars and coins dropped by 16% from the previous year's record highs. So what's behind this dip? A combination of factors, including volatile prices and increased competition from other investment assets like equities and cryptocurrencies, have temporarily sidelined some investors. But here's the interesting part. The tides might be turning. With growing awareness of silver's undervaluation compared to gold, remember, the gold-to-silver ratio is historically high. Many investors are beginning to see silver as a bargain. And when you factor in the potential for a supply crunch, the case for silver as a long-term investment becomes even stronger. The question now is, will we see a renewed surge of interest in silver as both a financial asset and an industrial necessity? History tells us that when silver gets its moment in the spotlight, the moves can be explosive. But the next piece of the puzzle could be the gold-to-silver ratio itself. Let's explore this key metric next.
Which frankly we should have done 2 years ago, is rather than continue the process with an overworked and beleaguered FDIC of chartering a de novo bank, a new bank, we have entered into a letter of intent to buy a very small existing bank, which has a national charter. The seller of this bank is a multi-bank holding company. We will buy the bank and then sell the existing loan book to the parent. So we aren't acquiring any assets that we don't understand. We are just merely buying a charter. This is about a $50 million bank. It's a very, very, very small bank. This will allow us to go back to the original regulator, the Office of the Comptroller of Currency, and the Fed that has to approve all of these transfers, both of whom we've had good historic relationships with. But importantly, we get out of the FDIC process because the FDIC national charter is already owned by this bank. In retrospect, this is something that we should have done 2 years ago. It's expensive, which is why we didn't do it. And our previous experience with the FDIC came at a period in time when the FDIC wasn't experiencing as much operational stress as they are today. The consequence of that is that we have decided to pay up for this little bank and amend their charter with our own operation so that we can get started much more rapidly. You know, Dunnigan, when we started Everbank, which you'll be familiar with, but many of your listeners won't, we had zero
Central bank policies and macroeconomic trends are playing an increasingly pivotal role in shaping silver's future. To understand why, we need to look at the broader economic environment and how it impacts the precious metals market. First, interest rates. Central banks around the world have been hiking rates aggressively to combat inflation. Higher interest rates generally weigh on precious metals, including silver, because they increase the attractiveness of yield-bearing investments like bonds. However, there's a shift underway. With inflation showing signs of easing and economic growth slowing, central banks are beginning to pivot. In fact, many analysts expect rate cuts on the horizon. This is significant because lower interest rates make non-yielding assets like silver far more appealing. Second, inflation. While inflation may be cooling, it's far from eliminated. Persistent inflation erodes the value of fiat currencies, making silver an attractive hedge. History has shown that during periods of sustained inflation, precious metals tend to shine as safe haven assets. Finally, the weakening dollar. The U.S. dollar, a major influence on global commodities, has started to show signs of softening. Since silver is priced in dollars, a weaker dollar typically translates into higher silver prices for international buyers. So what does this mean for silver? In short, we're heading into a perfect storm of economic conditions that could send silver soaring. Rate cuts, inflation hedging, and a declining dollar all create a fertile environment for a silver rally. But there's more to the story. Rick Rule has a unique framework for spotting opportunities in the silver market. In the next step, we'll explore his 80/20 principle and how aligning with the right players can make all the difference.
What you find is what are in effect truly superb bond portfolios. When I say bond portfolios, collections of loans or mortgages, privately negotiated bonds that aren't underwritten by Wall Street. You find invariably the banks, high-quality banks like that, have Tier 1 capital of between 15 and 22%. By the way, the FDIC considers 7% to be well-capitalized. What you find is that prudent private sector people seem to prefer 20 to 7 in terms of capital adequacy. So to the extent that individual citizens want to take control of their financial future, all they need to do is go to their bank and ask for something called the Statement of Financial Condition, which the bank must provide them. Look at how much Tier 1 capital the bank has. Ask the banker how much of their portfolio is marked held to maturity and what their maturities are. If you have a bank with 7 years of maturity that's being funded by deposits that are overnight demand deposits, you have a potential problem. Ask, too, the historic relationship between provision for loan losses and actual loan losses. What you find is that a high-quality bank over-provisions. They do that both out of prudence, and they do it, frankly, as a tax shelter. The money that they put into a provision is money that comes out of current income, which means that you are establishing a loss reserve rather than paying tax. The very good companies actually underreport earnings by establishing these reserves. I have seen banks and insurance companies that have decade-long records of having 6 times the reserves that they have experience, which is to say they're actually managing their earnings down in return for lowering their tax bill and operating more prudently. It's not difficult to find these things out, but sadly, most depositors and most bank shareholders don't do that kind of work.
Rick Rule, a seasoned expert in precious metals, often emphasizes the importance of focusing on the right players in the silver market. His application of the 80/20 principle, or Pareto's law, is a game changer for anyone looking to maximize their returns in this sector. Here's the concept. In any field, roughly 20% of participants generate 80% of the results. But Rick takes it even further. It points out that within that top-performing 20%, an elite 4% are responsible for the majority of success, nearly 6 to 5% of the utility in the market. When applied to silver investing, this means aligning with those few serially successful operators who consistently outperform the market. But how do you identify these top-tier players? Rick advises looking for management teams with a proven track record of delivering results, particularly during down markets. Why? Because it's in tough times that the best operators shine. For instance, names like Ross Beatty and Lucas London are legends in this space, known for creating immense value in the mining sector. Here's the catch: patience is crucial. Rick highlights that the most significant gains often take years to materialize, requiring investors to endure volatility and stay the course. Case in point is Paladin Uranium Investment, which faced a 90% decline before delivering an astonishing 10,000% gain over 5 years. So, what's the takeaway? To capitalize on the silver rally, it's not just about picking the right asset, it's about backing the right people. By aligning with proven operators, investors can significantly improve their odds of success. And speaking of the silver rally, what are the key triggers that could spark it? Let's uncover them next.
Could argue that classically this is fraud. But it's not fraud, I guess, if it's specifically allowed by federal charter. I think the other problem that I see out there, and I'll do this before I get to the good news, the other problem that I see is that I still don't believe the other shoe has dropped with regards to commercial real estate, particularly office space, but also some forms of other commercial real estate. I see all the time now anecdotal reports of buildings that sold in 2020 for $300 million, including $225 million in mortgage financing, changing hands for $50 or $60 million. It isn't just the equity holder that gets hurt in that transaction. If the lender has $225 million in first and second mortgage obligations, and the building changes hands for 50, that means that the lending institutions are out $175 million. And I think there's a lot of rot like that in the banking system. The good news is there's a lot of good banks too. Most of them fairly small. Most of them community banks in the truest sense of the word, where you have a board of directors who are part of the community, know the borrowers, know the depositors, where you have a management team that understands that you don't lend long and borrow short. You don't get caught in a duration spread or a rate spread, who understand, as certainly I've learned over 50 years, that the value of your assets is ephemeral, while the value of your obligations is always money good. Which is to say, people that underwrite loans intelligently. I'm a shareholder of several small banks. This is not a recommendation, by the way. But if you look at banks like Farmers and Merchants Bank of Long Beach as an example, or First National Bank of...
When it comes to silver's next big rally, several key triggers are aligning to potentially ignite explosive growth in the market. Let's break them down. First, industrial demand is skyrocketing. We've already discussed how solar panels, electric vehicles, and electronics are driving record levels of silver usage. But what's critical here is the urgency. Solar manufacturers alone are expected to consume over 20% of the world's silver supply by 2027. And this doesn't even account for growth in other industries like advanced defense systems and green energy grids. Second, supply shortages are creating pressure. With 3 consecutive years of deficits in the silver market, inventories are rapidly depleting. Analysts warn that without substantial new mining investments, this trend could lead to a full-blown supply crisis as early as next year. When demand outstrips supply by such a wide margin, prices inevitably react. Third, geopolitical instability could act as a catalyst. As global tensions rise, whether it's conflict in resource-rich regions or economic rivalries between superpowers, silver's role as both an industrial metal and a safe haven asset becomes even more pronounced. Finally, the macroeconomic backdrop is shifting. As we've seen, central banks are signaling a pivot toward lower interest rates, inflation remains a concern, and the dollar's strength is faltering. These factors combine to create a highly favorable environment for silver, both as an industrial necessity and as a hedge against economic instability. But here's the big question. Will these triggers be enough to push silver past its all-time highs? The final piece of the puzzle lies in understanding how all these forces converge, and Rick Rule's perspective ties it all together. Let's wrap it up in the apex.
Are good collateral, but I do. By the way, this doesn't cover physical precious metal that you buried in your backyard. For gold, silver, or platinum and palladium that's held in segregated accounts at any of Brinks, Loomis, or Viamat, we will provide what is in effect a margin loan or a letter of credit, so that you have access to the capital that you have tied up in your physical precious metals without having to sell your physical precious metals. I'm really excited about this product. The precious metals community is a community that I've dealt with for 50 years. I know these people because I am one. And I know that from time to time, somebody who has a bunch of capital tied up in physical precious metals has a need for that capital. Down payment on a duplex, a summer home, something like that. They don't want to sell the precious metals, particularly if, like me, they've been buying it for 25 years and their basis is way low. We would like to provide access to credit for those people. And I've already been told by depositors that the idea that their deposits are being lent against physical precious metals makes them feel much more comfortable as depositors, rather than having the money lent to some, leveraged buyout firm or hedge fund or something like that. What we're really trying to do, Donegan, is what we did at Everbank. We're trying to create a community, an aspiring community, a libertarian-oriented community, a community bank where the community isn't defined by geography, but rather where community is described or identified by values.
It sounds...
Everything we've explored so far points to one undeniable conclusion. Silver is on the verge of a historic rally, and the pieces are falling into place for it to reach new all-time highs. But how exactly will this happen? It starts with demand. Industrial applications like solar panels, electric vehicles, and cutting-edge technology are driving a relentless need for silver. With solar alone projected to consume a staggering portion of global supply by 2027, we're looking at a demand surge unlike anything the silver market has seen before. On the other side of the equation is supply, or rather, the lack of it. Silver mines are aging, new discoveries are becoming rarer, and recycling can only fill so much of the gap. This persistent supply deficit is creating a foundation for higher prices that's impossible to ignore. Now, layer the macroeconomic environment. Central banks are pivoting toward rate cuts, inflation continues to erode fiat currencies, and the U.S. dollar is weakening. All these factors traditionally support a rally in precious metals. Add to this the gold-to-silver ratio, which suggests silver is historically undervalued, and the potential for a sharp price correction becomes even more likely. Here's the final piece: Rick Rule's insight into market psychology and the importance of aligning with the best operators. As investors recognize the opportunity in silver in turn to proven industry leaders, the rally could gain unstoppable momentum. In short, all the forces we've discussed, industrial demand, supply shortages, macroeconomic trends, and strategic investing, are converging. If you've been waiting for the perfect storm to send silver soaring past its all-time high, this could be it. And if you found this analysis valuable, don't forget to subscribe for more in-depth market insights. Remember, this isn't financial advice, just a guide to navigating what could be the next big move in the silver market.
We're back to serve them. And I'm just absolutely delighted that we can do this.
How do people get on your list of interested parties?
The two ways to do that: you can go to battlebank.com directly, Or you can go to ruleinvestmentmedia.com. Many of your long-term listeners will be familiar with Rule Investment Media. If you go to Rule Investment Media, provided that you like what I have to say about natural resource investing, you are invited to list your natural resource stocks at that website. And I will, for free, with no obligation, rank them 1 to 10, 1 being best, 10 being worst. In the question and comment section at Rule Investment Media, simply write bank, and I'll put you on the list. Why would you want to be on the list? Well, first of all, we don't have 15 or 20 different deposit products, many of which don't pay interest. We have one, a high-yield money market account. If you want to write checks, that's great. If you don't, that's okay too. Either way, we pay you interest, competitive interest. The second is that Battle Bank, we believe that your IRA is your IRA, not just a receptacle for products from annuity issuers or mutual funds. That means that with a Battle Bank IRA, that your IRA can own an LLC and you can buy a duplex or a triplex. And by the way, we'd love to finance it for you. You can buy a franchise. You can invest in crypto if that's what you want to do. You can invest in private equity if that's what you want to do. I didn't even realize this was legal when we were forming Battle Bank, and I was scared to death of this product until the bank's lawyer sat down with my lawyers and said, no, this is all possible. I can't imagine a product that will appeal more to aspiring investors and individuals like your audience than the fact that their IRA becomes their IRA, not a receptacle for Wall Street product. And then finally, on the lending side, it's weird that no bank in the United States believes that physical precious metals